April 2022, question number 3, boy. Are we there? Are we there, somebody? Are we there? Are we there? Have we gotten the question? Have you gotten the question? Yes, thank you very much. So you're told that the following accounting information was extracted from the financial records of Kibo Limited regarding the defined retirement benefit scheme for its employees. So we have the net benefit obligation at the beginning of the year, net defined benefit obligation at the end of the year. Then we have, in this case here, the current service cost. We have contributions to the scheme. We have benefits paid by trustees. The market yield on high quality corporate bonds is at the rate of 5%. Assume there are no tax implications regarding the retirement benefit obligation. With suitable calculations, explain the accounting treatment of the various elements of the defined benefit scheme on the financial statements of Kibo Limited for the year ended 31st December 2021 in accordance with IAS 19, employee benefits. This is a very easy, straightforward question. Very, very easy, straightforward question here. Very, very easy, straightforward question. So, ladies and gentlemen, let me do the extract. Of course, the balance sheet is very easy. I'll do, in this case here, P&L extract. I'm trying to explain how I'm doing this. So, of course, P&L extract, what do we need here? In the profit and loss extract, I would need service cost. I would need interest. I would need, in this case here, the actuarial gain. Actuarial gain, stroke loss. Actuarial gain, stroke loss. Actuarial gain, stroke loss. It's only 1 year given really here. So there is nothing much. It's a free of charge answer here. Question here. Free of charge question here. Free of charge max, I mean. So in this case here, the service cost, how much service cost are you able to see? Somebody talk to me. How much service cost are you able to see? 200. Thank you very much. How about interest? How about interest? How about interest? Interest, I should be able to take what times what. I can see the rate of interest there. It's 5% of the opening obligation. 5% of the opening obligation. And the opening obligation, is there somebody who is able to see the opening obligation really here? The opening obligation here. The opening obligation. The opening obligation. We have 1850, isn't it? 1850, which gives me 92 point what year? 92 point, 92 point what year, somebody? 92.5. Then actuarial gain or loss, this I need the reconciliation thing. I need the reconciliation thing like that. And this reconciliation thing is not very hard. So in this case here, reconciliation statement, in this case here, for purposes of getting the actuarial gain or loss, the actuarial gain or loss, the actuarial gain or loss. So give me, ladies and gentlemen, give me the opening what year, give me the movement basically from the beginning of the year to the end of the year, beginning of the year to the end of the year, beginning of the year to the end of the year. So go ahead there and give Mwalimu here, the obligation at the beginning, the net obligation at the beginning, January. Are you able to see, ladies and gentlemen, that net obligation at the beginning? This morning, these guys are not talking to me. They are not talking to me at all. They're not talking to me at all. So the net obligation, ladies and gentlemen, what do we have there? The net obligation, what do we have there at the beginning? How I wish my students were talking to me as they normally talk to me. 1850. Thank you very much. So then what do you think will be bringing changes to this particular obligation at the beginning? What will make this obligation increase? Of course, as employees continue rendering services, isn't it? As they continue rendering services, automatically we expect now the employer to be making contributions to the plan. Will continue in this case here now, the obligation increases. So we have, ladies and gentlemen, the service cost. The service cost. So in this case here, is there somebody who is able to see the service cost there? Service cost. The service cost is how much? The service cost is how much? The service cost is 200, isn't it? The service cost is 200. The service cost is 200. I expect, because I owe these guys, especially if I owe them at the beginning of the year, by the end of during the year, of course, their money must earn interest. So in this case here, come and add interest earned. Interest earned. So the interest earned, already you have the figure, which is 92 point what year? 92.5. What else? What else? What else am I going to work with? What else am I going to work with? What else? What else? Is this everything? Hey, you, my good students, what? The contribution received, yes. Contribution received, now we know the effect, isn't it? Even if I don't understand so much, I know the contribution, in this case, received is increasing my assets, and therefore my obligation is net obligation. Net obligation is going down. So net, or rather the contribution must always be deducted. So the contribution must always be deducted. So contribution is how much? Contribution is how much? 225. 225. 225 like that. 225 like that. 225 like that. Now, what do you know about benefits paid out? You simply write for the examiner to demonstrate a broad and deep knowledge of the subject. Benefits paid out. In this case, here you write ignore. Ignore. Benefits paid out. Benefits paid out. Benefits paid out. In this case, ladies and gentlemen, because it's affecting both the obligation. So the obligation will go down and the asset is going down. So the net effect is 0. So these one here, benefits are paid out. Ignore. 0. 0. 0. Hot air. That is the thing, yes. Hot air. That is the thing, yes. Hot air. That is a language, yes. That is a language, yes. Hot air. Hot air. Now, ladies and gentlemen, then after that, we have the gain. We know here we shall have the gain. Stroke what year loss? Actuarial. 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 And then, of course, I will underline here, and then I come and put here the net obligation at the end. Net obligation. Net obligation. Net obligation at the end. Net obligation at the end. So are you able to see the net obligation at the end? Are they able to see the net obligation at the end? Net obligation at the end. Net obligation at the end. These guys are not talking to me. I'm seeing 2,000. I'm seeing 2,000. 2,000. I'm seeing 2,000. 2,000. I'm seeing 2,000. So then are you able to balance these things, ladies and gentlemen? Are you able to balance these things, ladies and gentlemen? Are you able to balance these things, ladies and gentlemen? And they give me the balancing figure. The balancing figure here, which will be your actuarial. Which will be your actuarial. Which will be your actuarial. 82.5. 82.5, I'm being told. 82.5 negative, right? I'm being told 82.5 negative. 82.5 negative. Simply come and take this 82. Don't even write a negative. Just take it 82.5 there. Put it there. Put it there. Put it there. But again, in advanced AFR, you must read the question severally. Several, not once, not twice. Now, let me ask a question to the students who are saying that they were a bit confused. Have these things become now a little bit clearer? Have they become a little bit clearer with this now second example, which will be the last example really for us here? Has it become a little bit clearer? Or the confusion in this case here now even became bigger? At least. So leader is saying it's again. The best thing, remember it's an obligation. What is the value here? What is the value that you guys got here? What is the total value here? What is the total value here? What is the total value? You add this, and then you subtract. What is the total value here, somebody? What is the total value? Somebody give me. What is the total value? What is the total value? 19. 1917 point what year, somebody? 1917.5 or whatever. 1917.75. Thank you so much. Now, but at the end of the year, we are realizing that the obligation has become bigger. The obligation has become bigger. So when the obligation becomes bigger, are you supposed to see it as a loss or a gain? That's a loss. That's a loss. It's a loss. It's a loss. It's a loss. But again, remember, there is nobody who will even check that really. I'm even surprised you guys are worried about that. I'll not be surprised. I'll not, whatever you get here, you come and post that answer here without writing whether, just write there gain stroke what year loss. When you are very, very sure is when you come and advertise whatever, you come and even write for him when you are very, very sure. But if you're not very, very sure, you, whatever figure you write there, just come and put it there. What you want to do is to pass, like that. Okay, so can I move to something different now? Can I move on to something different? Can I move on to something different? Can I move on to something different? No, you haven't finished this question. If you leave this question like this, again, you will not be able to get all the marks, imagine. Read the question again, read the question again, read the question again, read the question again. With suitable calculations, there is the concept of explain the accounting treatment. Explain the accounting treatment. So you guys don't provide explanations. Very few students, those ones who get awards, are the ones who provide explanations. They're the ones in this case here who do what here, who provide explanations. So, ladies and gentlemen, in this case here, the explanation here is about what here, especially these things here, whatever we have here. That any service cost, in this case here, any service cost is increasing what here, is increasing the obligation to the plan. And therefore, I will come and debit the P&L. I'll take this to the P&L as an expense. As an expense. Interest is an expense. I'll either debit the interest, whatever, interest, I'll debit this interest expense, or I simply take this to the profit and loss account. All right. Then we have, in this case here, this actuarial gain stroke loss. I can maybe take a screenshot of this for you to be able to, but they're basically explaining the same thing. Like the contributions into the plan are cash flows into the pension plan. They increase their assets. They increase their assets. They increase their assets. They increase their assets, and therefore reducing what here? The net obligation. The net obligation. But of course, they can't be taken to the profit and loss. Benefits paid are the amounts paid out of the plan assets to retired employees during the period. These payments do not affect the net defined benefit plan, as they reduce both the plan obligation and the plan assets. The remeasurement component, actuarial gain stroke loss, is charged or credited to other comprehensive income for the period, and classified under items that will not be recycled or whatever. So in this case, the gain stroke loss is charged or credited. In this case here, we'll of course take this as a debit because it is what here? It is a loss. At least when they tell you to explain, you should try in this case to put some words into whatever that you have been doing there for you to be able to get all the marks. So mine was simply to throw in some light to you in a way that you will be able to get more than 60% of the marks. More than 60% of the marks. More than 60% of the marks. Unfortunately, I have this. Okay, why don't we do an SFP? SFP, in this case here, this was an easy one. SFP. The extract SFP. Statement of financial position extract. So you simply give us the net obligation at the end. Net obligation at the end, which is 2,000. Then you are done. 2,000. Net obligation at the end, you are done, because it is just 1 year. You're done. Thank you very much for asking those great questions. Now, there is something small that I would want us to look at here. This concept of what here? Curtailments. Curtailments, curtailments, curtailments. Curtailments, this concept of curtailments. Contribution, no. Because the obligation is given at the end. Contribution, or the obligation is given at the end. That contribution, which, or not contribution, but obligation given at the end, it has already been adjusted. It has already been adjusted. If I just explain here, you see this figure here, I can't come and subtract. I can't come and subtract, in this case here, the contribution here. I can't come and subtract the contribution because already, to get this, already we had subtracted. Great. Now, curtailments can easily come to you guys in the form of theory. Remember, under curtailment, basically we are coming as a RSCM and telling Britain, hey, now we want to stop paying you guys. Hey, would even want to start, in this case, reducing the contributions that we are doing to you guys for our employees. So when you make changes to, especially negatively, curtailment is about negative, right? When there are redundancies, for example, in the company, and you are going to, in this case, you put a stopper at the plan fund, then automatically you are curtailing operations. And you're being told here, under curtailment, let me see here. Look at this illustration here. But I would have wanted to really show you guys. Read for you. Summary of the amounts recognized in the financial statements. So for profit or loss, these are very important things. Profit or loss, in this case, you take the service cost component. We have, in this case here, the interest component. Then we have other comprehensive income. You take the remeasurement component, which is the actual gain. And then, of course, we have, in this case here, the statement of financial position. We have the plan assets, the plan obligation, or the net of it. And then we have what we call the asset ceiling. Please, I have to explain what asset ceiling is later after I finish tackling this curtailment that I can't see the description up there. We'll understand by doing this question. So you're told AB decides to close a business segment. They've decided to close a business segment. The segment employees will be made redundant and will earn no further pension benefits after being made redundant. Their plan assets will remain in the scheme. They're going to remain there till they retire. This is a curtailment without settlement. So we have curtailed, we have said we are not longer taking money there, but the money will be left at the plan till they hit 60 years. Before the curtailment, the plan assets had a fair value of 500,000. And the defined benefit obligation had a present value of 600,000. It is estimated that the curtailment will reduce the present value of the future obligation by 10%, which reflects the fact that employees will not benefit from the future salary increases and therefore will be entitled to a smaller pension than previously estimated. What is the net gain or loss on curtailment, and how will this be treated in the financial statements? Ladies and gentlemen, this is a very easy question. Asset ceiling. I said I'll first of all finish this, and then we will tackle it. Great. Now, ladies and gentlemen, what are we doing here? So in this case here, we are basically accounting for curtailment. So we have here curtailment. So curtailment, what do we have as usual? Don't start with assets. Start with obligations. So we have here the obligation, the plan obligation. the plan obligation. And then we have, in this case here, the plan assets. Original. And then we have after curtailment. After curtailment. So original, I hope you have been able to take the screenshot. Original, I hope you have been able to take the screenshot. So original, so the original, in this case here, we are told before the curtailment, the scheme assets were 500,000. So plan assets here, original, 500,000. And then they've told us that the obligation was 600,000. Obligation was 600,000. So in this case, are you able to give me the net obligation? Are you able to give me the net obligation? The net obligation. Are you able to give me the net obligation? The net obligation, somebody. The net obligation, somebody. The net obligation, somebody. What do we have here, somebody? 100,000, isn't it? 100,000. Is that okay? 100,000. So in this case here, we have 100,000. 100,000. 100,000. Great. And then once we called out for curtailment, we are told the obligation will go down by 10%. Our obligation will go down by 10%. 10%. So then can you kindly give me the obligation after curtailment? So after curtailment, it will be 600,000 times 90%, because you see 10% reduction. 10% reduction. 10% reduction. So then this will give me what, ladies and gentlemen, here? Somebody is telling me that it is giving us 540,000. 540,000. 540,000. 540,000. 540,000. Remember, assets were not being affected. It's only the obligation that has reduced here upon curtailment. So the assets are going to remain still the same. 500,000. 500,000. So this 500,000. So in this case here, then the new net obligation will be what here? Somebody will be 40,000. This minus this, 40,000. So in short, ladies and gentlemen, the obligation has done what here? The obligation has reduced. The obligation has reduced by what here? The difference. The obligation has reduced by 60,000. The obligation has reduced by, is it 60,000? No. This figure is not correct. People are telling me that, Mwalimu, this figure is not correct. This figure is not correct. It's 60. Sorry for that. So this is supposed to be 560,000. So this is supposed to be 60,000. Sorry for that. 60,000. And therefore, you're saying that the obligation has reduced by what year? The obligation has reduced by 40,000. The obligation has reduced by 40,000. The obligation has reduced by 40,000. So are we okay up to there? 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 Remember, they told us on curtailment, the obligation was reducing. The obligation was reducing. The obligation, let's see here. Let's see here. Sorry for the confusion. Sorry for the confusion. They told us here. They told us here. Let me just show you here. Great. They told us here, ladies and gentlemen, they told us here. Yeah. They told us on curtailment. Let me see. Let's read again. Let's read again. Let's read again. AB Limited decides to close a business segment. The segment employees will be made redundant and will earn no further pension benefits after being made redundant. Their plan assets will remain in the scheme so that the employees, the plan assets are remaining in the scheme until these guys retire. Before the curtailment, the scheme assets were 500, worth 500. So the plan assets were 500,000. And the defined benefit obligation has a present value of 600,000. So these two, I believe those two, ladies and gentlemen, we must be really okay with them. I believe these two, we are very okay with them, these two here. Because these are the original figures. These were the original figures. Those were the original figures. And then what are they telling us, ladies and gentlemen? What are they telling us, ladies and gentlemen? Great questions. Great questions. So they're telling us, ladies and gentlemen, here, before the curtailment, the scheme assets had a fair value of 500,000 and the defined benefit obligation had a present value of 600,000. It is estimated that the curtailment will reduce the present value of the future obligation by 90, or rather by 10%. Look at me, by 10%, which reflects the fact that employees will not benefit from future salary increases. So, ladies and gentlemen, let's be very, very keen with this. Simple mathematics. Let's be very, very keen with this. Simple mathematics. So in this case here, the obligation is reducing by 10%. If the obligation reduces by 10%, so the reduction is 10%. The reduction is 10%. Reduction, so 10% of 600,000, 10% of 600,000, in this case here is 60,000. Sinikweli. And therefore, what is the new obligation after the reduction? What is the new obligation after the reduction? What is the new obligation after the reduction? Now they're not talking to me anymore. We have a dispute. It should be 500 what year? 540,000. 540,000, which in this case here would have been the same as taking 600,000 times 90%, because 10% is a reduction. 10% is a reduction. Then I'll be able to get this 540,000 like that. You guys are the ones. There must be somebody who confused me here. There must be somebody who confused me. I don't know who it is, but there must be somebody who confused me. There must be somebody who confused me here. There must be somebody who confused me here. There must be somebody who confused me here. Therefore, ladies and gentlemen, which is part of learning anyway, therefore, ladies and gentlemen, in this case here, we can see 40,000 like that. So then if that is the case, the obligation has reduced. The obligation has reduced by how much? What is the obligation reduction? You can see the net of, initially it was 100,000. After curtailment, now it's 40,000. So the obligation has reduced by how much here, somebody? The obligation has reduced by 60,000. Is that okay? The obligation has reduced by 60,000. The obligation has reduced by 60,000. The obligation has reduced by 60,000. Has reduced by 6. So this is again. And remember, any curtailment, gain or losses, they are normally adjusted in the service cost. I'm repeating again. Any curtailment, gain or losses here, they are adjusted where? In the service cost, in the service. So you go to the service. If for example, the service cost in the year is 120, and then there is a gain of 60, you'll come and do what here? Again, of course, is opposite of cost. You have to subtract. So we are repeating again. If you're asked here that curtailment costs are normally done what here? Curtailment costs are normally adjusted on. So this is very, very important here. Very, very important. The gain on curtailment is 60,000, and this will be included as part of the service cost component in the profit or loss for the year. Actually, I even don't want you to go to the mathematics of this. I simply wanted to bring about, because of theory, this concept of what here? Curtailment. For you to know what curtailment is. And for example, if we have gains stroke losses on curtailment, that we are going to adjust the service cost that we have in the P and L. The P and L. And then now I should be able to go to the last thing in this case here, which is what here? Which is the asset ceiling. Yes. Yes. Great. Gain, we add. You see, Lois, if you are given, Lois, if you are given a cost and a gain, can you add them? Can you add them? They are opposite. They are opposite. They are opposite. So gain, you do what here? Somebody, you deduct. If it's a loss becomes a cost. A loss becomes a cost. You do what here? Yeah. A cost, in this case here, you do what here? You add. Great. Now, ladies and gentlemen, from there, we go to something very important, what we are calling the asset who? The asset ceiling. Asset ceiling here. It's here. The asset ceiling. Very, very important. Remember, ordinarily, pension schemes are normally troubled schemes. Many organizations, including governments globally, are struggling with pensioners. It will always be, in most cases, pension net. The net has to be an obligation. But if it goes the other way around and then you get like a very rich pension scheme, which has got a net asset, that net asset has to be capped. It's not easy to handle pension schemes. Pension schemes, ordinarily, the obligation has to be more. So they talk of net obligation. But if the asset is higher, and then now you have what we call a net asset, then the asset cannot be left to go to heaven. It will be cheating us. The asset in this case will always be capped. So you're being told here, asset ceiling, most defined benefit pension plans are in deficit. The obligation exceeds the plan, although some defined benefit pension plans show a surplus. If a defined benefit plan is a surplus, IAS 19 states that the surplus must be measured at the lower of the amount calculated as normal, and then the total of the present value of any economic benefits available in the form of refunds from the plan or reductions in future what-year contributions to the plan. This is known as applying the asset ceiling. It means that a surplus can only be recognized to the extent it will be recoverable in the form of what-year refunds or reduced contribution. I don't even have to understand what they're saying there. The most important thing is for us to see how this example has been done. The following information relates to a defined benefit plan. So I can see the fair value of plan asset, and I can see the present value of pension what-year liability. Present value of future refunds and reductions in future contributions is 70. What is the value of the asset that should be recognized in the financial statements? Great. So I will do this thing as a normal thing, the way I normally start with this. So come and give us, ladies and gentlemen, the plan obligation. The plan obligation. So we have here the plan obligation. So we have here the plan obligation. We have here the plan obligation. So we have here the plan obligation versus the plan what year versus the plan assets. So the plan obligation, what do we have here at the end of the day here? The plan obligation, what do we have here at the end of the day? The plan obligation, what do we have here at the end of the day? The plan obligation is 800. And then the plan's assets are worth what? They are 950. So subtract the assets of as usual, then you'll be able to give me the net obligation. The net obligation, which is minus 150. So basically net obligation negative, that is the same as what here? Net assets. So we have net assets worth 150. Basically the assets are more. The assets are more. The assets are more. The assets are more. Whenever assets are more, ladies and gentlemen, that is a risk. That's a risk. People will start saying that now we are doing very well. Let's even increase the pension amount here to the retirees. And then you get into problems as a pension plan, a pension scheme. So whenever you have net assets overally, you must now project the cash flows that you expect into the plan. And those cash flows, then you'll need to discount them. You need to discount them. So in this case here, come and look for anything you're given there called the present value of, for example, cash flows, the plan's cash flows. Are you able to see in this case here, are you able to see the present value of the plan cash flows? Can be out of whatever, but the present value, 70 years, 70 years, 70 here. The present value of future, they're calling the 70 years, 70 years, 70 years. So in this case here, 70, and then you compare the two. In this case here, you compare the two. To be able to get the ceiling there, you compare the two and pick the lower. Always pick the lower. So the lower here is 70, and therefore, when you go to the SFP extract, the SFP extract, SFP extract here, what you'll do, now you'll be talking of net what here? You'll be talking of net assets here. Net assets here. Net assets, pension scheme. Now you can't book 150 because there's a ceiling of what here? There's a ceiling of 70. That's what you book there. It is a ceiling of 70. There is a ceiling of 70. There is a ceiling of 70. So that's what you book there. So, and that is it. That is it. That is it. That is it. So, ladies and gentlemen, as we disappear. So today, as you go to your workplace and then somebody tells you, asks you guys, you guys, you wake up very early to study. What have you been studying this morning? What, in this case here, are the key takeaways that you'll be able to talk about proudly. What I'll never forget about this IS-19. I like cliff, curtailment. I hope you're ceiling, right? Asset ceiling. So when you're explaining asset ceiling, remember, first of all, it has to be a plan which has a net asset. When net assets are more, you must always look for the present value, and then you work with the lower. That's how you explain this in your theory. In different direction. Where a lot of people talk to each other. The reconciliation, at least when they're saying reconciliation now, that benefit paid is hot air. Benefit paid is hot air. Benefit paid is hot air. Okay, I'll be able to share, yes. Interest calculation on the beginning, 14. Very good. Interest calculation is always on the beginning balance. So then go ahead there and write. Go ahead there and write as a topic there. Right there as a new topic, IAS 12. IAS 12, taxes. So when we meet, we shall be able to look at these taxes, especially the deferred taxes. So that is it. It's my belief that you have given this particular topic the efforts which are required here to enable us pass. So it has been a pleasure hosting you this morning. I look forward in this case here to teaching you today again in the evening. But today it's at what time? 10 p.m. theories. Bye-bye. Bye. Great.